Part 3, how rates work. Banks borrow money from customers' savings accounts and from the Federal Reserve and then lend that money in the form of credit like car loans and mortgages. They pay interest on the money they borrow. For customers with savings accounts, they give you a small percent to save with them, and for the Fed, the Federal Reserve sets the rate at which they lend money. Both of these costs ultimately determine the rates you see advertised. Those advertised rates not only include the cost the banks have to pay to borrow, but also a margin on top for the bank to generate enough money to pay for the cost of doing business and turn a profit. Simple example. The bank pays 1% per year to customers who park their money in a savings account. Banks pay 5%, for example, to the Federal Reserve for borrowing money from the government, which is the rate you hear about in the news when the headline says the Fed raised rates. So if the cost of the money is 1% to savers and 5% to the Fed, that's 6% off the bat that the bank has to make to cover the cost of the money they're lending to you. Then on top of that, they have to tack on another 1 to 2% for their overhead and a profit. So that's a mortgage rate of 7 to 8% total. Anything under that and you're paying for it somehow, guaranteed.